Hello, everyone, and welcome to our May 27th, 2010 Forex training here on FX Street. We're both very glad to be here today. Now, just a quick disclaimer that we do not give buy, sell, or hold recommendations, and that trading in the Forex is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. So today is part 2, using unambiguous trading tools to trade trends and keep fear to a minimum. This is going to be a presenters today. Greg Michalowski is the FXDD Vice President and Chief Currency and Trading DD. Know him from his speech and his work he does on the commentary pages at FXDD on a daily basis. We're so very excited that he can be here today. Now, if you want to get more information from Greg, you can get him on Twitter, twitter.com/GregMikeFX. I'm Sean Powell. I'm one of FXDD's national trainers. I will be acting as a moderator today to answer and get your questions into Greg when we go to Q&A. So here we've got a couple things going on at FXDD that I'd like you to know about. First off is our trading contest. This is called our pole position bonus. We are one of the official sponsors of the Red Bull racing team, and each time they win a race or place second or third, we offer a bonus for new trading accounts. This week it's an 8% bonus, so definitely there is no better time if you are looking to open a trading account than to do so today. You can do that at FXDD.com. The other contest we have going on is our trading contest, one of 6 once of a lifetime, 2 Red Bull Racing team paddock passes to one of the Formula One events. This also includes $5,000 for travel and accommodation. Very exciting contest. We've also got a number of other prizes, including cash and Red Bull merchandise. You can get all of the details at FXDD.com. All right, so some webinar housekeeping. Today's training is going to be on Forex market analysis and trading strategies. It's also about how to find trading opportunities for yourself. Greg, as Greg always likes to say, it's how to teach you how to fish on your own. Now, please participate, make it great by asking questions in the chat window. And then you can also learn more about Greg Michalowski at the blog on FXStreet.com. It's FXTrader-link. We've got it right here, so you can take that link and watch a little bit more about Greg. Okay, now we're ready to get started. What I'm going to do is I'm going to pass the microphone and I'm going to pass the ball to Greg. So I'm going to do that now. Greg, go ahead. Mike.
All right, and yes, good. And can everyone see my PowerPoint presentation? All right, good. Well, my name is Michalowski, as Sean does. Thanks for the introduction. This is the second part of a series, and the series is going to go over 4 different parts. And the first part, if you haven't been able to, or you didn't see it, I'm sure it's on the FX Street website. You don't necessarily need have that education. We'll kind of go through things a little bit slow here today, and I'll make sure I'll keep everyone in the loop as far as what we're looking at and why we're looking at it, and so on and so forth. But the other thing I want to warn you is that when I talk for an extended period of time, I have my throat gets ticklish, and so if you hear the mic go off and then come back on, you know that I have that a coughing sensation, so I just have to clear my throat. But with that said, let me remind that we're going to be talking about using unambiguous trading tools to trade the trend. And I put in the small parentheticals and keep fear to a minimum, because we know as traders, or I know as traders, that you all out there, people who are listening here today are in for a reason, because you want to become a better trader. And part of the thing that you have to control as a trader is your fear. And so a lot of my theme of my trading and certainly of my education of trading has to do with controlling fear, and you'll see the point when I talk about unambiguous and ambiguous trading tools, which a lot of you may not know what they are right now, but we'll go through them today. And this was a quote that I heard Maria Bartiromo say on CNBC last week, and she was talking about fear, and she said, "How do investors invest with fear in the market?" It seems that there is a lot of fear in the market. This is fear from the European situation, and fear in the UK with their elections, and fear that we're going to head back into a recession, and Spain and everything else. Everything is fear. So how do you invest in fear? And my answer is by following what the market is saying. following what the market is saying. And what is the market? The market is clearly the price. The price is telling you about what the market is saying as far as the fundamentals go, or which way the market is going to go, up or down. And so you follow up. How do you follow what the market is saying? And my answer to that is by listening to what the market price action is telling you and applying technical tools to the price action. The fact is, folks, is that the price is the only thing that we know out there. You may have an idea about the fundamentals of and which way the market is going, up or down, whatever, but that doesn't explain. It doesn't necessarily always come through in the action and the price. For instance, the euro goes down yesterday and the euro goes up today. Well, as the fundamentals have materially changed, we still have the same situation in those countries. And maybe there's little wiggles and waggles here along the way, but by and large, Greece is still Greece, Spain is still Spain, and all that other stuff. And the only thing that we do know, however, is the price is changing, the price is moving, and if you apply technical tools to what that price is doing, you will be better prepared to trade with the market, trade with the market rhythm. As I like to say, you want to be in rhythm with the market, and you don't want to tell the market what to do. You want to follow what the market is saying, and that's the way that you trade successfully, is trade like the market. If you were if you listened to our webinar a week or so ago, we outlined what our game plan was going to be, and what my game plan is for trading. And what we've discovered is that if people trade the trends, and this is nothing new, you read it most of the books. If you follow the trends, if you trade the trends, you're going to make the most of the money. And the other part of our game plan is we want to keep our fear to a minimum. We want to keep our fear to a minimum. And I look at this, the game plan that I have for my trading to trade the trends. You're going to make the most money trading trends. They're fast, they're directional. You get higher highs and higher lows. And if you catch the trend, you're not worried about losses. You're worried about losing some of your gain, and that's an important psychological advantage that you have if you trade the trends. Trends also move faster. So I think we'd all agree that if you can trade the trends, you're going to be much better suited to make money in the market. The other thing that you have to control is your fear. You have to control your fear. Fear is a trader's worst enemy. If the trend is your friend, fear I consider to be the devil, and you have to be able to control your fear, and that's not an easy thing to do. So what we try to do is we try to use things like unambiguous trading tools, and we'll get into that in just a second. Now, if you also listen to our report a week or so ago, we had different rules, and we had 5 different rules, and I'm just going to pinpoint one of them right now because it has to do with unambiguous trading tools. And Rule 3 says that the tools in our trading box, that is the technical tools that we are going to use in order to analyze the market. If we're going to trade the trends, they need to be trend-defining tools. So that's number 1 that we need. The next thing that we need from our tools in our trading box that we're going to use is tools that can help define our risk. And why do we want to define our risk? Because if we define our risk, if we know what our risk is, all we have to do at that point is to say to ourselves, are we comfortable with this risk? Can we afford to lose this amount of money? And if we can, say to yourself, I have no fear. I have no fear. My fear is dissipated. It's dispersed. It's gone. And that's a psychological thing that you have to do as a trader, is to find is to find those points, have a reason to do a trade, and define your risk. So our tools that we use in our trading, the tools that I encourage you to use, need to define our risk. And the third thing that our tools and our toolbox that we're going to use to analyze the market need to do is they need to be unambiguous tools. Unambiguous tools. What is an unambiguous tool? Well, we'll go through that in just a second. But I also have a quasi rule, and this quasi rule is, or kind of rule in small letters is, you should keep your tools to a minimum. too many tools, if you use too many tools, too many technical tools in your analysis, then it just adds confusion. And what does confusion do? It adds to your fear. So you have to keep your confusion down by keeping your tools down. If you have too many tools, you have too much stuff that's going on, and you just increase your fear. So I said, what is an ambiguous tool? I said we need to use unambiguous tools. And an unambiguous trading tool is my definition is one that gives either a bullish, that is a buy, or a bearish, that is a sell bias. It's not black. It's black or white. It's red or green. It's yes or no. It's not gray. It's not yellow. It's not maybe. It's either bullish on one side, bearish on another side. All right? That's an unambiguous trading tool. That's what I call an unambiguous trading tool. And that is the type of tools we're going to use. So let's contrast to it an ambiguous trading tool. An ambiguous trading tool is one that does not give a true bullish or bearish bias. That is, it gives a gray, it gives a yellow, and it gives a maybe. It's not black or white. It's not red or green. It's not yes or no. It's not bullish or bearish. It's things like oversold. It's things like overbought. It's fundamentals. Fundamentals can be ambiguous. These are ambiguous trading tools that people use on a daily basis, and the ambiguity in those tools that you use cause uncertainty, and uncertainty causes fear. If you think that if a market is oversold and it continues to get oversold and get oversold even more and oversold even more, meanwhile you bought when it was first oversold, what does that do to your mindset? What does that do to your confidence? Increases your fear and decreases your confidence. And I want to steer away from those. I don't want to follow those. So pop quiz: is relative strength is relative strength is an that's a fix that slide. Is relative strength an ambiguous or unambiguous trading tool? Relative strength index an ambiguous or unambiguous trading tool? First one to answer wins a free today. It's ambiguous, right, Paul Volcker? It is ambiguous. It is ambiguous. Paul Volcker wins. And why is it ambiguous? Because it gives an oversold and overbought condition. Is it one of the most widely used trading tools out there? Yes. Is it something that Greg Michalowski uses and tells people to use? No. It gives you some clues, but those clues, it can also give you some ambiguous clues, and some ambiguous clues that don't work are going to get you in trouble. It happens all the time. Is stochastics an ambiguous or unambiguous tool? And I'm sure everyone also knows that that also is an ambiguous tool as well. So two of the most used trading tools out there from a technical basis, the ones that you read in all the books, you will not read that in mine when it comes out, is are ambiguous trading tools. And these are tools that I think increase the fear, and you don't want to use them in your trading, or I don't want to use them in my trading, even though I did in the past. I don't want to use them in my trading because they provide too much uncertainty for me. They aren't black and white. They aren't red and green. They aren't yes or no. They're a maybe. They're a gray. They're a yellow light, and it just doesn't do me any good. Oops. Now, is gold an ambiguous or an unambiguous trading tool? Gold. This is one of those intermarket spreads, and of course I always put ambiguous up there as well. You can see here in this chart here, this is from Bloomberg, and this was actually done last week. But gold is the white line here in this orange line. You can see that it tracks very nicely here. Gold's going up, the euro's some here, and the gold going up was a trading tool. And we know why, or most people that is happening is because gold is coming even into the market out there, and the euro is out there. And gold, as Paul Volcker says, has emotional issues as well. it becomes a store, becomes a safe haven. You have to be careful. It can go back and forth and kind of whip you around very quickly. So I always caution people that it doesn't always stay as a safe haven. There are the biggest holders of gold, for one, are central banks, and they may need to sell some of their gold reserves in order to fund some of their issues that they may have. Also, everything doesn't go up forever and ever and ever. So gold is another one of those things that is a ambiguous a trading tool or an ambiguous clue for the market. And again, here I have another one that the slide is a little bit messed up, but are fundamentals ambiguous or unambiguous? And fundamentals can also be one of the more ambiguous trading tools that people often use. And the thing is that people will, if you ask people what they think of the market, 99.9% of them, say you're at a cocktail party and go to a cocktail party and someone says, oh, you're in the financial market, okay, what do you think about the market? And you're going to go off and start giving this fundamental bias, and it's natural for people to talk fundamentally. It's a kind of a way to impress everybody knowledge about them and kind of low going, and also probably keeps the other person in touch. But what we should be thinking about as traders is not the fundamental, not thinking that you want to. The market is your guiding light. The market price and the technicals that move along with that market price are your guiding light for success or failure as a trader. The market does not care what your fundamental perspective is. You should care what the market is thinking, and the only way that you know what the market is thinking is by watching the price. The price will tell you everything about what the market is thinking, and let the people who write the commentaries in the newspapers and on the websites and who go on CNBC tell you what the fundamentals are that are moving the market. Because yesterday they were saying one thing, and today they might be saying another thing, because the price goes down yesterday, the euro goes down, today it goes up today, and so the stories change, and they'll just move the storylines to reflect what the market price is saying at all times. What you as a trader have to do is you have to follow what the market price is, because that's your best clue. And so, one of the theories for me, people not catching trends, is that they are too fundamental. I don't care, we don't care, and no one cares what you think. I care what the market thinks. The only way I can gauge the bullish or bearish bias is through the market price. So finally, we get to the tools that we use in our trading box, our trading toolbox. And we discovered that there are three tools that we use in our traders toolbox, and one of them is a simple moving average. The other one is trend lines, and the third is Fibonacci retracement levels. So if we look at just a simple moving average to begin with, what we have here is the first is that the characteristics of a simple moving average are they define trends and non-trends, and that's one of the requirements that we needed, that it had to be a trend defining tool. Now, I also said that it defines non-trends, and one of the things that a moving average does, obviously, if the moving average is moving to the upside, the trend is which way? To the up, is bullish. If the moving average is moving down, which way is the trend? The trend is down, it's bearish. Now, if the moving average is moving sideways, what does it tell you about the trend? The trend is non-trending, and that's often an important clue as far as anticipating trends. We may go through a little bit of that as we get to our charts, and we are going to get to charts, folks. So don't you worry. The other thing that characteristic of simple moving average is it gives an unambiguous trading bias. Once again, it's either bullish or bearish, and that keeps your fear down. The third thing it does is it helps define risk. And the fourth thing that it does is I'm going to go back to this previous slide. The fourth thing it does is it's an unambiguous trading tool, and we'll in that if the price moves above a moving average, which way is the bias? The bias, it's bullish. If the price goes below the moving average, which way is the bias? It's bearish. That's the way that you should be on the market in general when you're looking at a moving average. Now we look at we look at a 100-bar moving average, and this is a moving average that the market looks for, and that's going to be my trigger. And the second moving average that I take a look at is a 200-bar moving average, and that is my confirming moving average. So why don't we start by looking at some charts, and I'll explain. Sorry, I'll explain some of the. I'm going to turn this off here, this PowerPoint off, and I'm going to go to my charts. Click on this. Come over here. Boom. Okay, do you see my Euro daily chart there? Let me move it up a little bit, like right there. Okay, does everyone see that? Okay, good. All right, we'll go to the charts, and I'm going to go through some of the tools that we use in particular, so things like simple moving average, the trend line, and Fibonacci retracements. And again, all of those tools are what I call unambiguous trading tools. And we'll see what kind of clues they give, and then we'll compare it to the tools that I consider ambiguous trading tools, and we'll see which kind of wins out. This is kind of the battle of the trading tools, and kind of prove my point, I guess, a little bit as far as what you should be using as a trader. But before we get there, are there any questions out there right now that anyone has out there that I could answer from what we've gone through so far? Give you 5 seconds or 10 seconds. All right, everyone's with me? Great. All right, that's fantastic. So what I like to look at is I look at 3 different time periods in my charts. The first one is then I look at I look at the 100-day moving average. I look at the 200-day moving average, and the 100 is always blue, and the 200 is always green. If I'm on the hourly chart, the lines remain the same. This is still the 100, but in this case it's 100 hour. This is still the 200, but in this case it's a 200 hour. And then if I look at the 5-minute chart, the blue line is the 100-bar moving average, and the 200-bar is, or the green line is a 200-bar moving average. So that is the way that I look at the chart. So what we know here is that the blue line is 100, that the green line is a 200. That's our moving average. I have a trend line in here. I don't have anything. I have a Fibonacci. That's a long-term Fibonacci level. Actually, one of the things I'll point out here is if I go to the euro dollar, because I have this Fibonacci euro on a month, I take the low price of the euro since the price has been in existence for the euro when it came in as a currency to trade as one currency. If you take the low and move it up to the high, the 50% retracement comes at 121.31. Now, if I go back to my daily chart, you can see that this 50% retracement, 121.31, was where the market pretty much stalled out a few weeks ago at the lows. So that level is a key level for the market, and all of you traders out there should be aware of that. But if you want to know where this 50% retracement level comes from, it actually comes from that monthly chart. So what this is an unambiguous trading tool. If the market goes below the 50% retracement level, we should see the market move down below that 50% level. Okay. The other thing from this chart pattern here, and I'm looking at this week right here on the daily chart, is that the market moved below this trend line here at around the 124.19 level. This is this week's trading range, 124.20. This is today. This is Wednesday, Tuesday, and this is Thursday. So the trend line came in around the 124. 20, 16 to 20 level, depending upon where you are in that chart. And that's of significance from a trading perspective. Trend lines are unambiguous trading tools. Why? Because either you're bullish above it or you're bearish below it. Would everyone agree with that? Yes, I think everyone would. So from a perspective here, when you have a nice trend line here connecting lows here, low here, low here, low here, when the market breaks below that trend line, you should see the market move to the downside here. What happened at this point right here? At this point right here, the market should have gone lower. What did it do? It didn't go lower. it reversed, and then actually that caused this sharp move to the upside. So just because a trend line breaks doesn't necessarily mean that you stay in that position because Greg said it was going down. What you do is, if the trend line breaks, you should see the market go down. If it doesn't go down, that is, if it moves back above the trend line, what does it turn the bias to? It turns it back to positive. So you have to get out of that position. And in fact, the market used that level as support the next day, and that helped push the market to the upside. So oftentimes the market will at these what I call borderlines, the market, or using unambiguous trading tools, at the borderlines where the market should go lower. If it doesn't, then it's going to tell you the other thing. It's going to say get out, and in fact, you may want to look to buy against the trend line again to see if the market can go higher. Now, when the market came down again off of this high right here, it went down through the trend line. Market went down to test our 50% retracement level off the monthly chart. When we moved back above the trend line, the market moved higher, and now the market again is back below that trend line. So you can see how the importance of this chart here, and the reason why I'm showing it here, is because we have an unambiguous trading tool, and this trend line is becoming a key level for the market, for your traders, and this allows you to trade trends to the upside and to the downside in the market that allow you to take advantage of the moves in the market. So again, this line was broken at 124.20. Now let's go to the hourly chart here, and I'm going to go back to that same day. And I put in a line here at, well, there's a horizontal line at 124.18. I don't think I can actually, I don't think I can, yeah, okay, 19. That's the closest I can get, moving the line here. This is, Monday, so the week day. And the one thing that we could do in this chart is we can also draw our trend line. Now in this chart, our moving average, ambiguous trading here, and from Friday's trade, and last week's trade, we had moved above each of the 100 and the 200, and you can see here how we moved above the 100. We had trouble here at the 100, but then the market based against this 100-bar moving average and started to move to the upside. Moved to the 200, used the 200 as a support level here. And then on Monday, what happens? The market not only it breaks a trend line here at this point right here. Initially, it comes down, tests the trend line, breaks a trend line on ambiguous trading tool. There, trend line. It runs into the 200-hour moving average. It moves below the 200, moves below the 100, and then starts to use 100 as resistance. Also at this level is, what is this, 124.19.20 level. That 124.19.20 level goes back to this point right here. So these is how you watch the market and try to develop your clues from these unambiguous trading tools that we use. We had one a bearish bias triggered when the market went through. We had another market went through the 200-hour moves. We had a third bias broken when the market moved below the 124.20 off the daily level. We had a fourth negative bias broken when the market went through the 100-hour moving average. So this correction to the upside here is consistent with what the market is telling us, the clues that the price of the market is telling us. It gives us unambiguous ideas about which way the bias is for the market. And when the market comes up to this 19 level, it has the 200 moving average above it at around the 124.42 level. It has the 20 level as resistance as well. Traders were more than happy to sell at this area. Why are they more than happy to sell at this area? Because their risk is very small. Their risk is just it could be if the market goes above the 25 level, the market moves back within above this trend line right here. That could be a stop level, or the market moves back above the 200 hour moving average at the 124.42 level. That's also a stop level. So traders will look for low risk trading opportunities against unambiguous trading tools that say it's bullish on this side, it's bearish on this side. So when the market holds this 19 level, holds the 20, holds the comes back down below the 100-hour moving average, it's off to the races to the downside, and you get this trend to the downside that takes the market all the way down to our lows here that occurred on what is that on Tuesday at the wherever that level came in at the 121 something or other, 121.78ish type area on the downside. And note here. So, and what were they buying against? Well, they're buying against this low down here. They're buying against these lows over here. The last time the market went down at that level, you can actually see here that there's, you know, the move to the upside took off from this low area. The market found some profit-taking buying. Where do we go? We go right up, test the 200 bar moving average on this chart. Now let's add another element in here. And I'm going to take this off here. If you recall that the three tools that I use are trend lines. I use the trend lines. I use moving averages, and I also use Fibonacci retracement level. So when the market found a bottom here at the lows here, the market started retracement back up, went up to the 200, went above the 38.2. But quickly rejected this 200, and you can see here that the market then started to use a 38.2% retracement as resistance level, and the market started to move back to the downside. Note here, from a technical perspective, off of this hourly chart, what are we seeing? We're seeing this 100 and 200 bar moving average continue to hold the top side resistance here in the chart. This is what the market tends to do. It likes these 100 and 200 bar moving averages, follows these 100 and 200 bar moving averages, and it'll use them as areas where traders can trade against. And if the market should move above these unambiguous trading tools on this corrective move to the upside, what would you do? You would change your bias to the upside. You'd look for the market to further correct to the upside, and you kind of change your tune in the market as the price action tells you what to do or what not to do. So is everyone with me on that? All right. So now I said I would take a look at some of the unambiguous trading tools, and you notice on the bottom here I have the RSI here along the bottom of the chart. This is a 14-bar RSI on the euro versus U.S. dollar. And the thing that what RSI people or people who trade the RSI will often say is that 30 is the oversold line and 70 is the overbought line. I have the RSI for demonstration purposes here, Fuji. So the 30 is the oversold and the 70 is the overbought line. So in this case, the market obviously is in a downtrend here. The moving averages are moving down. We broke through the trend line, broke through these moving averages. You can draw a trend line to the downside as well. So the bias is to the downside. Now at this point right here is where the market started to Sean. The market started to move below the 30 level. So someone who is following the RSI would say that, well, we've already moved down here. The market is broken. On Monday, we started to come down. We're getting oversold at this point. I'm going to be looking to buy. I'm going to be looking to buy a level down here because the market is oversold. And lo and behold, what does the market do? The market continues to go lower and lower. It corrects, and where does it correct to that point where the market initially went oversold? It certainly doesn't, provide you any sort of a large move to the upside. Here, actually, I was looking at this point right here. So the market gets oversold at this point right here, and it certainly doesn't provide you any upside momentum here. And in fact, it continues to go lower and lower and lower. And at this point right here, it finally bottoms. The bottom of the RSI occurred at 18.4815. But during this whole move to the downside, which took the price down from 123 to 121.77, what do? What does a trader who trades the RSI do during this point? Where is your stop? Or do you just wait on the market? Do you just wait for it to correct up to the point where you initially got in, by the way? I mean, if you waited for this whole correction, you would have made, 20 pips on the trade. Meanwhile, you lost 150 or whatever to the downside here because you followed the RSI. What do? An ambiguous trading tool like an RSI, one of the reasons why I don't like using it is because it doesn't tell you where you're wrong. It doesn't tell you where your stop is. All it tells you is that the market is, oversold, I guess, and eventually it's going to move higher. Well, I know that as well from the technicals. I know that the market is eventually going to move higher. I know that this bottom has a potential to move up as well, and I can show that to you by looking at my charts. I can show you that I can anticipate that this move is going to move to the upside here at this point right here, better than what this RSI could have told me at any point right here. But what I do know is that my bias to the downside was negative here, negative here, negative here, negative here, and there is no reason why I should have gotten out this move to the downside. And I'll show you why when I go to my next chart, which is going to be my 5-minute chart. So you can see the ambiguity in this. So you can see the ambiguity in the RSI, and you can go back in time, you can find other things. So let's take a look at the 5-minute chart. Again, I said I look at all three of these charts, and this is that 124.19 level here, and this will be my final chart that I'm going to look at. So I'll be wrapping up here. But you can see here that the 5-minute chart has at the 124.19, when the market broke the 124.19, we corrected up, went a little bit above the 100, went to that key resistance level on the daily chart, 124.19, and then started to move to the downside. You can see here how the market broke through the 100-bar moving average on the 5-minute chart, and during this whole move to the downside, where the market was saying off of the hourly chart, this is on the 25th, the market was saying here on the 25th that the RSI is oversold, that the market is oversold here, right? All during this point right here, market is saying, the market is oversold, we're due for a correction. What is the 5-minute chart saying? It's saying, we're below the 100 bar, we're below the 100 bar, we're below the 100 bar, we're below the 100 bar. And finally, at this point right here, when the market goes above the 100 bar at 122.30, the market says, okay, the trend is over. Let's see what happens. Market goes up to the 200, tests the 200, not ready yet, comes back down to the 100, goes back up to the 200, still deciding what it wants to do here. Do we want to go lower or do we want to go higher? I'm not telling the market what to do. The market is telling me what to do. And the market says, okay, we're going to find support against 100, we're going to go against 200, still not there, break through the 200, move higher. So you're out here. The market, the moving averages, the unambiguous unambiguous tools that we use, the moving averages, you can put a trend line here as well. It probably comes right down at the same point right there. In fact, I'll put that in there. Boom, 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 take the high here. Come down right there. Our trend line and the moving average are telling you the same thing. The market came down, tested the trend line, tested the moving average, started to move to the upside. This is what the market looks at. The market, folks, is simple. The market tries to find unambiguous trading points along its way that will give it the simplest, most easy trading decisions. Do I go long or do I go short? And if it stays above this line, I'll follow it till it tells me to get out. And if it goes below this line, I'll get out. If I bought here, I'll get out. If it goes below this line, I'll sell and look for new lows. But you go a long time, and you can see here how the market tends to follow these moving averages. The market is not non-trending here. Look, 100 comes down to 100, does the same thing. Moves up, comes down, tests the 100, tests the 100, moves below the 100, comes down, tests the 200, moves below the 200, blah, 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 blah. The story is the same. That's the end of my presentation here. You can go back. I don't have the RSI in my charts. I did it for demonstration purposes, but put a 14-bar RSI in your charts. Look at those times where the market gives you an ambiguous trading oversold or overbought condition, and you'll see how you can get in trouble by trading those ambiguous trading tools. Look for the unambiguous trading tools. Look at the moving averages. Look at trend lines. Look at Fibonacci retracement levels. They'll give you some good signals. So that's the end of my discussion here today. If you want to send me a question, a specific question, my email is greg@fxdd.com. If you want to listen to my daily blogs, which, by the way, I'm on vacation this week, but I'm happy to be here with you today. Next week, we'll be getting up. Send me an email at greg@fxdd.com. I also contribute to the FX Street pages, and I'd be happy. Please subscribe to those. There's a lot of ways that you can hear my thoughts, hear my ideas about the market. I use the same analysis that you heard here today, using moving averages, using trend lines, using unambiguous trading tools in order to put the odds of success in your favor and allow you to trade
Thank you so much, Greg. I know everybody enjoyed this, and we want to thank Maud, Vicky, and Dinda for having FXDD present here on FX Street. And again, we've got our disclaimer up here just to thank you all so much. And we will see you back in 2 weeks for the third episode of 4 in Greg's training. So Greg Michalowski, thank you so much. I'm Sean Powell, and we will see you in 2 weeks.